So you've left a job. It's a moment filled with a lot of uncertainty, and your finances, well, they're probably right at the top of your mind. It can feel like a lot, I know. But look, this is also a real opportunity to get things right. So let's build that plan together. Okay, so the deed is done. You've officially moved on from your old job. Now, let's just forget all the complicated financial jargon for a minute. What you need right now is a simple, straightforward checklist to make sure your money and your benefits are secure. Let's walk through it step by step. Now, I know what you're probably thinking about first, your 401k. And don't worry, we're definitely going to get to that. But before we do, there's a much more immediate problem we have to address first. I call it the benefits cliff. So what exactly is the benefits cliff? Well, it's that one specific moment, and for a lot of people, it's literally their last day of work, when that whole safety net your employer provided just disappears. It's a sudden, immediate gap in your financial protection that you can't ignore. And let's get really specific about what's on the line here. We're talking about your health insurance. You know, a single trip to the emergency room without it can be financially devastating. Then there's your life insurance, that core protection for your family. And finally, disability insurance, which protects your single greatest asset, your ability to earn an income. Leaving even a tiny gap in this coverage is a huge risk. Okay, so once you have a game plan to bridge that insurance gap, then we can shift our focus to your long-term savings. So let's talk about your 401k and how to make the smartest move. This is a big one, and honestly, it's where a lot of people get confused. The answer to who owns the money isn't as simple as you might think. It all comes down to one really important word: vesting. You absolutely have to understand this difference. Look, any money that came out of your paycheck and went into your 401k, that is always 100% yours, no question about it. But the money your employer put in, the company match, that's a different story. That money only becomes yours once you're fully vested, which is all based on a timeline set by your company. If you leave too soon, you could actually lose some or even all of that match. So, once you know exactly how much money is yours to take with you, what do you actually do with it? Well, it really boils down to four main options. And trust me, the path you choose is going to have a huge impact on your financial future. So the four paths are pretty clear. You can just leave it where it is. You can move it to a new company's plan. You can roll it over and take complete control yourself, or you can cash it out. Let's break down what each of these really means for you. All right, let's look at the first two options. Leaving your money behind is, well, it's the easiest choice. You literally do nothing. But the downside is you can't add any more money to it, and you're stuck with whatever investment options they have. Rolling it into a new 401k is great for keeping things tidy, all your money in one spot. But now you're limited by that new plan's investment choices and their rules. And that brings us to option number 3, which is all about taking control. When you roll your 401k into an individual retirement account, an IRA, you are putting yourself in the driver's seat. The world of investment choices opens up wide, giving you way more flexibility to manage your money your way. And inside an IRA, you can do something really powerful. You can use an annuity to create what is essentially your own personal pension. Think about that. This can set you up with a guaranteed paycheck for life, income that you literally cannot outlive. It's how you turn a pile of savings into predictable, reliable income for retirement. Okay, we have to talk about that fourth and final option. And I need to be really, really clear here. This is almost always the single most destructive financial decision a person can make in this situation. Cashing out your 401k is like a triple whammy to your savings. First, you're going to owe income taxes on the whole amount, which can easily bump you into a higher tax bracket for the year. Second, if you're under age 59 and a half, bam, you get hit with another 10% penalty right off the top. And maybe worst of all, you lose all of that future tax-deferred growth. It's just a terrible, costly mistake. So let's just pull this all together. We've talked about two big separate things, right? You've got the urgent, right now problem of replacing your insurance, and you've got the big, long-term decision about what to do with your 401k. It can feel like you're fighting a war on two fronts. But what if you didn't have to? What if you could solve both of these complicated problems all at once with just one simple conversation? Get one clear, cohesive strategy for your whole transition. That's exactly what we do. As an independent agency, our entire specialty is helping people through this exact situation. We can walk you through the 401k rollover process and at the same time, shop the market to find the best options to replace your lost insurance. The whole goal is to make sure there are absolutely no gaps in your financial protection. It's really easy to get started. You can visit our website at annuityexpertadvice.com or just give us a call at the number you see right here, 770-755-1565. We'll walk you through that all-important 60-day rollover rule and compare all the insurance options to make sure you stay protected. Leaving a job is definitely an ending, but you know what? It's also a brand new beginning. It is one of the rare times in life you get to take total control of your finances and build a stronger foundation for your future. So the only real question is, are you ready to take it?